Hi, my name is Stuart Weems and welcome to the Investopoly podcast. Our goal is to share easy to understand evidence-based holistic insights to help you master the game of building wealth. And so let's get into today's Q&A episode. I'm going to answer a question from Charlie, and Charlie actually recently followed us up in regards to that question, and maybe one of those questions or that his question slipped between the gaps. So just to let everyone know, we've now kind of redesigned that process where, we've reduced the human error element, I guess, and there shouldn't be any more questions that kind of slip between the gaps anymore. Of course, we tend to have about sort of 6 to 8 weeks of backlog in terms of questions. So as I've always promised, I'll answer every question, address every question. I'm not going to cherry pick or anything like that. Could take a bit of time, but rest assured now we've got a better system in place to follow through. But if I've said this before, if you sent your question a couple of months ago, I haven't responded or Campbell hasn't responded, do let us know and we'll make sure we'll get to it. So Charlie sent this in February. So firstly, I apologise for that, Charlie. Charlie writes, thanks for the great podcast. Been listening for a couple of years now. Good listening to the diverse issues you work through. We immigrated to Australia in 2018 from the UK, where we always had saved into our employer self-invested personal pension. Before we left the UK, we transferred our funds to a company who invested the funds on our behalf in a wrap product. The initial transfer was £80,000 for me and £103,000 for my wife. Funds have now grown to £115,000 for him and £157,000 for her, which doesn't seem too bad. We understand we can only transfer these funds to an Aussie super fund after age 55, and then it needs to be transferred into a QROPS account over here. We recently asked them to reduce fees, so they've now invested us in a Dimensional World equity fund. Fees were 2.18%, now reduced to 1.84% on mine, similar for my wife. Our supers are building slowly. We've purchased 2 investment properties and own our home outright. We have no intentions of returning back to the UK. Of course you don't. So the questions that Charlie has is the restrictions on transferring to Australia, is that correct? And 2, how do we get away from the high fees while residing in Australia? Okay, so it is correct. 55 is soonest you can bring back your monies, although that is changing, increasing to 57 on the 6th of April 2028. So I'm not sure how close you are there. And you can establish a self-managed super fund, but the trustee needs to really comply with the QROPS legislation and restrictions. QROPS is a acronym you probably would have guessed by now, Qualifying Recognised Overseas Pension Scheme. So obviously spent a lot of time thinking about that acronym, or that name I should say. And yeah, you can either establish a self-managed super fund and it's got to have a specific trustee, or you can go to what's called Australian Expatriate Super Fund, which is the only QROPS retail fund in Australia. And the issue here is the UK requires that the terms of the pension or the super fund in Australia are very similar to the pension fund in the UK. From what I understand, the UK doesn't have any ability to release funds early. So in Australia, if you've got financial hardship or medical expenses, there's certain ways you can get access to your super before preservation age, so before 60. And so the fund needs to be a bit more strict to mirror what's going on in the UK. So that's kind of the issue around it. And it's a bit of a complex area. Well, it's a lot of a complex area. And you really need to get someone specialist to help you potentially move those funds as well. Okay, how do you get a lower cost? Well, this is a really good question, Charlie, and it's something that, Australians should really reflect on. From what I know, and I'm certainly not any sort of global expert on this, but from what I know, the Australian financial services industry and the Australian financial planning industry, it really does compare exceptionally well to other countries in terms of the cost of advice, the ability to get independent advice, and the cost of investing. In Australia we have, it's really good. I think it's really good. It compares really well with other places around the country. Now, of course, you would have heard me say many times, fees are certain, returns are not. So certainly, when you're in a high fee environment, a strong market returns mask it to some degree, and exactly what Charlie's sort of observed. He's sort of gone, well, it's working. It's been working pretty well. maybe you don't need to worry about it so much. But fees, I think you always need to think carefully about. And sometimes you can go too low in fees, by the way. Sometimes if you go absolute bare bones, which is going to be, full market cap indexing, sometimes you're leaving money on the table. So it's not about going to the absolute lowest, like Host Plus index balance, for example. It's not always going to achieve the best outcome, but you've got to be conscious of fees. So Dimensional World Equity Fund, I haven't looked it up, but I bet they don't charge more than 0.4%. It's probably even lower than that. So therefore, it looks like that the advisor's charging 1.4% on the funds. Not bad business if you can get it, because they're probably not doing very much work for that money. I think if anyone is in any jurisdiction other than Australia, and of course I can't firstly, I don't give advice on this podcast because I don't know everyone's circumstances to the detail that's necessary to give personal advice. But specifically, I'm not licensed to give advice on products that are outside of Australia. So this is very much just for information. But if anyone has any jurisdictions, my first starting point is Vanguard. And so my understanding is Vanguard does offer a SIP product, so self-invested personal pension. The charges are about 0.15% in terms of a platform fee, and then you'll pay and that's capped at £375 per year. And then you'll pay, ongoing investment fee that's probably going to be 0.2%. But I think, once you add it all up, you're looking at 5 times lower fees in a Vanguard arrangement. And will it beat Dimensional? Well, who knows what's going to happen. Dimensional's sort of a value fund, index fund manager. I think Dimensional probably will beat Vanguard over the next 10 years, but I think that it's certainly not worth paying 1.8%. And that's true for anyone listening to this podcast. What would I think an acceptable fee? And so sometimes if we invest in emerging markets, the fees can be 1%. And that's normal because it's a more expensive fund to run. And you're not going to put a lot of money in emerging markets, probably less than 5% of your portfolio. But so it's not an absolute direction, but on a weighted average cost, I would be becoming more concerned if my weighted average cost for investments was more than 0.4% overall. I think our portfolios, for instance, weighted average cost is 0.3%. So, again, you don't want to go absolute bare bones. Sometimes it's important to get exposures that do attract higher fees, but overall, it should be relatively low cost. So thanks, Charlie. Thanks for writing in, and sorry that we missed your question initially. Okay, next question is from Angela. Angela writes, I'm a loyal audience of your podcast. It's helped me enormously. Thanks so much. You're very welcome. Angela's question is in regards to episode 350, where I talked about using a investment company, non-trading investment company, to invest in property. And one of the benefits of doing that is that you can sell the property, pay capital gains tax, but get a credit for that tax and gradually drip feed the dividends out of that company, thereby getting a refund, hopefully in retirement when you've got little to no personal taxable income, getting a refund for that tax paid. And I worked out that roughly you might end up paying somewhere between 10 and 15% if you take it into account the time value of money in tax, as opposed to 23.5% if you just had the property in your personal name. Okay, so Angela's question is related to the loan structure related to that company, that how to set that company up. Maybe I should have been, more specific in the episode in the blog. How you set up the company and how you structure the loan is really going to depend on how you're actually going to structure the company and how you're going to benefit from the negative gearing. But to my mind, what we want to do typically is have the negative gearing in our personal names, because it just means that we've got higher marginal tax rates, right? So if I'm self-employed, or even if I'm a salaried individual, and I can earn up to $190,000 before I pay 47%. But if I'm earning more than $190,000, then I'm going to get 47% negative gearing. Whereas in a company it's 30, in a super fund it's 15. So certainly personal name gives you better negative gearing benefits. And we know just from an internal rate of return perspective, it's mathematically powerful to reduce the amount of cash flow you got to put into a property, in terms of funding its negative cash flow. So personal names is the right way to go. So then how do you do it get the negative gearing and personal names into a company? Well, this is where it gets a little bit complex, and this is where you need to really have a good holistic advisor, I think, to be over the top of this, because it is a bit complex for the average person to understand. But essentially, how you do it is that you borrow. And I did explain this in the blog. I think you borrow to buy the shares in the company. You don't borrow to buy the property. And so let's say it's $1 million, $1 million property. I will go to the bank and say, I want to borrow $1 million, and I'll come back to the security in a minute. I'm going to borrow $1 million, and then I'm going to use that $1 million to buy 1 million shares in my new company at $1 each. And so the company raises money through issuing shares to you. So the $1 million, the actual cash, goes into the company. The company then buys the property. So in the company, we've got on their balance sheet, we've got an asset, the property, $1 million, and then we've got issued share capital, which is $1 million, and that's your balance sheet. I've got my loan now in my personal name. Now, the company can pay a dividend to me if it wants, and it probably should, just to make sure that we're not looking like we're trying to avoid tax too aggressively. So the company will pay me a dividend, which is the net rental income, less company tax, but I get a credit for that. And then I've got the interest deduction in my personal name. When the company decides to sell the property, as I said, that the capital gains tax is trapped inside that company. So how does the broker structure the loan? Well, the broker structures the loan by saying the borrower is the individual and the security is held in a company. And so the director of that company needs to provide a security guarantee. So really, you've got the applicant is the individual and the guarantor is also the individual, but in their capacity as the director of that company. Now, not every bank's going to necessarily do that. Not every broker is going to understand that structure, but that's how you do it. Again, I think it's about finding yourself, and I've spoken about this in many times in the podcast. It's really about building a team around you. If this is not your core business, don't make it your core business. It's good you listen to podcasts like this. I mean, I'm not trying to talk you out of not continuing to listen. Still do that. Some knowledge is very, very important. It's critical, in fact, but you don't need to become the expert. You just need to know enough so that you can choose the best advisors to put around you. So it is a bit complex, I acknowledge that, but hopefully that answers your question, Angela. And I think it's a structure, I've only just sort of been contemplating in the last couple of years. But that's the thing, right? And I sort of beat myself up about it. I think, wow, why didn't I think about that 10 years ago? But that's the thing, right? We hope, I hope this podcast is really good today. I can guarantee you in a year's time, it'll be much better. And that's the whole thing of constant improvement. Anyway, I'm getting off track. Thanks, Angela. Okay, next question is from Tony. Love the podcast. Your wisdom and level of insights is second to none. Thanks so much, Tony. Quick question, please. My inquiry relates to another question you answered for a couple in their mid-30s, asking how do you know if they should put additional monies into super? You spoke about the $2 million tax-free in super and used 65 as your example of a retirement age. You mentioned that the $2 million tax-free amount a few times. Question is, won't that $2 million increase? Is Mr. Chalmers kind enough to index that with inflation? $2 million is a lot of money today, but in 30 years, $2 million will buy me a box of Cocoa Pops. You're right, Tony, of course, it is indexed. So we're talking about what's called the transfer balance cap, which is the amount that any individual can have in pension phase. You have a lifetime transfer balance cap. So if you begin a pension this financial year, your transfer balance cap is $2 million. That's your lifetime cap. But if you commence your pension last year, the transfer balance cap was 1.9. That transfer balance cap will continue with you. So it really is depending on when you begin the pension. And so the planning opportunity here is try and delay as long as possible beginning the pension, particularly if we feel like we're on the precipice of another indexation. And it's indexed in $100,000 increments. And so when we do our financial planning for clients, what we do is we project forward what we think the transfer balance cap is going to be. Now, they could remove indexation of that transfer balance cap at any time. They could also play with the cap. Like when it gets to 2.5, they might bring it back to 2, for instance. But it's legislated in law, we don't need to thank Mr. Chalmers for that because he didn't legislate that law, put into force that law, I should say. But it definitely is indexed, and that's a planning opportunity, right? So Actually, I might just pull it up now. So I'm looking at the financial model now. In 10 years' time, transfer balance cap is projected to be 2.5. So because it's indexed in 100,000 increments, it's going to index quicker. Every couple of years it'll rise by 100,000. So actually we think we're projecting it rises by 100,000 the following tax year. Anyway, so 2.5 in 10 years. In 20 years, 3.2. In 30 years, 4.1. So it's important to think about that in your planning, because if you're going to retire in 10 years' time, for example, don't necessarily bank on it being $2 million inside super, try and get a little bit more. Anyway, the whole idea is that if we've got this transfer balance cap, let's say we've got a spouse, today we can have $4 million of net worth in super that's going to be zero tax. That's pretty good. So to my mind, everyone should be thinking about, how much wealth do I think I'm going to have at retirement? And if it's less than 4 million, or for retirements in 10 years, it's less than 5 million because the transfer balance cap was 2.5, then you've got your key strategy point is, how do we get this money in? Now, it doesn't have to get in there by age 60. You might do it over your 60s because you've got to deal with the contribution caps and so forth. So you might then pay a little bit more tax in your early 60s than you necessarily need to, but it doesn't have to be an overnight thing. It's another thing that I've mentioned more recently with property investors. People that are heavily invested in property, will end up paying a lot more tax in the long run. And it's something that's, I don't think has been, people pick on negative gearing in terms of, property investors getting a free kick. But I think there's, over the life of owning property with rates, council rates, I know it's not a tax, but it really is, CGT, land tax, income tax, all these things, I think property investors pay more than their fair share, and certainly more than share investors inside superannuation. Okay, next question is from T. T writes, loving the podcast, especially recent Q&A episodes. Thanks so much for all the great insights you share. T, the Q&A episodes, I really enjoy doing them. And I was thinking this morning, the positive side effect, sounds egotistical, is that, you get a lot of feedback, firstly, great feedback, which I obviously really enjoy, because anytime you put some effort in, it's good to get positive feedback. But also the other thing is that podcasting tends to be a one-way conversation, and this has created more of a two-way conversation. It's good because it also frames, some of my thinking around blog topics and podcast topics for the Wednesday episodes, knowing now what the audience is, or better understanding probably what the audience are thinking and contemplating and so forth. So thanks, T. Anyway, T writes, my husband and I are in our early 30s with combined super of just under $180,000. Currently invest in AMP High Growth Fund. We're considering setting up a self-managed super fund to purchase a property in the 500 to 550 range, likely to have a 5% rental yield. Our plan is to buy in high growth area, hold for 4 to 5 years, then sell and use the profits to buy 2 more properties. We'd then look to repeat this every 5 years or so, gradually building a property portfolio within our super. We know this is more aggressive strategy, but with a 30-year time horizon, we feel like we've got time on our side to maximise growth. I'd love to hear your thoughts on whether this kind of self-managed super fund property strategy could realistically outperform a high growth managed fund over the longer term, and by how much. What's the best way to compare the two, especially when accounting for the higher fees, compliance costs of running a self-managed super fund? So it's a really interesting question there, T. And I wrote a blog and recorded a podcast episode 348, where I compared a sort of similar strategy, not inside super, but I compared a similar strategy outside super in terms of buying property, enjoying, hopefully you're buying just before a growth cycle, and then divesting when that growth cycle ends, and then putting that money somewhere else. And I guess I've done these numbers before in terms of self-managed super fund versus personal names. On one hand, you're going to pay only 10% in capital gains tax, whereas the maximum you'll pay outside super is 23.5%, so 13% less in terms of tax. But the negative gearing isn't as great as well. Plus, also you've got the higher interest rates inside self-managed super funds, it's about 1% higher, maybe sometimes a little more, and the higher transactional costs. So not only to set up a loan, but to do all the paperwork in terms of bare trust and those sorts of things. The things that jump out at me is you say you're going to buy in a high growth area for 500 to 550 with a 5% rental yield. That says to me you're either 5% rental yield, you're buying in a location that is grossly undervalued. And so because the intrinsic value is higher, the rental yield's inflated, or you're buying in an area where there's not a lot of supply demand fundamentals, and that's why the rental yield is high. The first situation would obviously be attractive because if I'm buying in an area that's undervalued, then, I could buy for 500 today and in 4 or 5 years' time, that asset could be worth 800,000 or something like that. But it's then identifying, what is that? Where is that location that's going to pop? And in that episode 348, I talked about you need to factor into this strategy that every single property you buy isn't going to pop in the time that you think it is going to. And so there's a risk associated, it's a higher risk associated with this in that for the strategy to work well and for the strategy to beat a traditional way of investing your super, you have to be perfect every single time. That is, you've got to buy into the market just before it takes off, and then you've got to take your profits, when it's the right time. So you don't want to hang on to that market too long for it to level out, nor do you want to sell too soon either and miss some of that growth cycle. And then you've got to repeat that process. So as soon as you sell that asset, you've then in the next 6 months, you've got to find the next area, and you've got to continually do that continually well. But that's not my major concern. My major concern is really understanding how to build wealth. And this is one of the fundamental reasons why I record this podcast. The easiest way to build wealth is compounding capital growth. It just takes a long time. That's the only ingredient is patience. And you said you got a long time horizon. And so my answer to your long time horizon is compounding capital growth. Because remember, if you get 7.2% capital return, your asset value is going to double every 10 years. So you've got 180,000 of super, let's call it 200 just to make the maths really easy. So 10 years, you've got 400. In 20 years, you've got 800. And in 30 years, got $1.6 million. That's without any additional contributions. Now, of course, if you can pile in some additional contributions to that, the compounding gets even better. But I was looking at a portfolio that has been in existence for about, this is for an up-and-coming episode, for about, I think around 10 years, I want to say, maybe slightly less. And the client is contributing, I think, $20,000 a month into that portfolio. I only just changed to 20. It was $10,000 a month for, the first 8 years or something like that. And in the last 12 months, the portfolio in terms of capital growth has returned more than the client's contribution. So he's put in, obviously 12 times 20 is 240,000, and the capital growth was like 260 or something like that. That's the power of compounding capital growth, is in the earlier stages, your capital contributions are really important, and it's the same in super. In the longer run, though, it's about compounding returns. And that's the easiest way to build wealth. So I would say, T, in your situation, you can't access super until you're 60 anyway. So it doesn't matter how successful you are, even if you shoot the lights out, it's not going to help you retire sooner. You've got a 30-year time horizon, use it to your advantage. Invest in a way that over the next 30 years, you're going to maximize the compounding capital returns on that portfolio, knowing that you're not going to lose too much in tax anyway. 10 to 15% over that time in terms of tax rate. So I'm not in love with the idea. In fact, I'm not in love with the idea at all. I think it's much higher risk. I think the probability of you achieving better outcomes is very low, like less than 10%. And for all the time, hassle, worry, and stress about it, to take a risk that has a 10% probability of working, clearly, I'm not in favor of it, but that's my view. But thanks for writing in and thanks for thinking about it, because I think, it's good to consider these things. It's good to contemplate these things. Is there a better way to do it? And well done for asking that question. Okay, next question is from Dave. Dave, I'll just sort of paraphrase or summarise his question. Dave owns his home in regional Victoria worth about $1.3 million. Self-employed, runs a successful business, but would like to retire to either Melbourne or Queensland in 17 years when he's 60. Dave borrowed $900,000 against his home to fund some business growth, but the business can now refinance that loan and repay him, so that debt will be in the business, so we don't need to worry about that. So essentially, Dave has no debt. Dave's mentioned that with the business sale and super and everything else, he'll have enough money to support his retirement, $250,000 a year. So we can kind of say, okay, we've got the home, no debt, and retirement's secure, or we've got a plan around retirement. The main concern is really being able to afford a property in Melbourne or in Brisbane. We said Queensland, but I don't know if it's Brisbane. Anyway, Melbourne or Queensland in 17 years' time, noting that his asset is worth 1.3 in a regional location. He wants to buy something that it would cost him today $2.5 to $3 million. So we've already got a pretty significant gap. Notwithstanding, over the next 16 years, you would have to assume, in fact, if I'm building a strategy, I think the most reasonable, even if you might consider it conservative assumption, is there's going to be a growth gap between those two markets. I would say probably of at least somewhere between sort of 0 and 2%, but probably at least 1%. So if I'm building a strategy like this is what I'm going to assume, that growth gap is going, in real terms, in today's dollars, going to widen substantially over the next 16 years. So just to put some numbers around that to make this point really clear, because this is a really important financial planning point that Dave's brought up, is that the growth gap at the moment, or the price gap between what he owns and where he wants to be, where he wants to live, and remember, where we want to live in retirement, we need to own, hopefully with no debt. So using after-tax dollars. The growth gap, so 1.3 versus say 2.75, so something in the middle of 2.5 to 3, is 1.45 million. If regional area grows at 6% and Melbourne or Brisbane grow at 7%, in today's dollars, in 16 years, that growth gap will be worth $2.3 million, so more than double in today's dollars. So that's why I just wanted to go through those numbers to demonstrate how important it is to build a strategy around this point. Okay, let me digress. Dave proposes 3 potential options to deal with this issue. Redraw against the home, borrow $900,000, as well as contribute, some of his own cash over time, and build a property portfolio. A share portfolio, so a geared share portfolio. So regular investing, which I've spoken about previously in this podcast, and gradually drip feeding that money in over time. Buy an investment grade apartment in Melbourne for about $1 million, or go and buy a property in those markets for $1.5 to $2 million. Although he says that, that's going to be a stretch and may come with some potential lifestyle compromises. And so finally, Dave writes, I'll seek detailed modelling and advice, but would value high-level thoughts. In my experience, many advisors avoid recommending geared share strategies and also lack the experience to assess the trade-offs, including property strategies, properly. Thanks for your great work you do in helping others build wealth. So, Dave, it's an excellent question, and it's really good for, there's probably lots of people it's going to apply to, lots of listeners that are sort of thinking about this in terms of where they want to retire and what they want to do. And there's a couple of kind of key issues here. So the geared share strategy, I think it's a good strategy. Is now the right time to do that, though? We're dealing with, well, certainly as I'm recording this, share markets at all-time highs. To me, is not a time to begin a pretty aggressive share gearing strategy. I would do a little bit of gearing, but maybe not so much. But that could be the answer, right? In that strategy might be, okay, I've potentially got 900,000 to borrow, but initially I'm going to start off with, say, 7,000 borrowed funds per month and 3,000 of my own cash, 70% loan to value ratio. And I'm going to put $10,000 in the market. If the market was to crash, and I'm sure, every 5 to 7 years we get a volatility event around 30%. So if the market was to drop 30%, yeah, sure, then you could more aggressively gear into that market, buy aggressively on the way down and then through the recovery. That could work. So I guess it's not really just thinking out loud, it's not really the strategy I'm concerned with. It's more about the implementation of that strategy. But is it really going to build that? Is it going to bridge that growth gap? That growth gap is like 1.5 million versus in 16 years, $3.2 million on an after-tax basis. Is it going to be enough? I don't think it will be. I think it's better than nothing, but it's not the most effectual strategy. The most effectual strategy would be to go and buy that parcel of land that you want. So it's not about buying the dwelling, because the dwelling, construction costs will change, but not to the same compounding level as underlying land values. So I'm not too worried that if you have to renovate in 16 years' time, that it's going to cost more today. It definitely will, but I'm not too worried about that. What I'm really concerned about is buying into a particular location without needing then to compromise on lifestyle, because obviously what we're trying to do here is come up with a good financial plan that's going to meet our goals. And so if I know if I'm living in a regional location, hey, I'd love to be in Hawthorne, for example, or whatever it might be in Melbourne, let's build a strategy to achieve that so that I don't have to compromise. And, instead of being Hawthorne, I'm kind of in the middle of nowhere because of affordability. So what I would do then, using the Hawthorne example, is I would say, well, I want a reasonable sized dwelling. It doesn't need to be a huge family home, but I want 300 square meters, for example. And then I'd go about buying 300 square meters of land in a really good location. Now, it's going to have a dwelling on it, of course, but who cares about the dwelling? Which is what I would say, except if there was, really significant planning restrictions that were going to stop you building what you wanted to build. But that's and I think probably with a budget of 1.5 to 2, you probably can do that. And if you did that, I think that is going to be the most effectual strategy to help you minimize the risk of not being able to afford that price gap. The only problem is you mentioned Melbourne or Queensland. And I say it's a problem because I don't really want to sell the property in 16 years' time. So, it could be financially, in terms of not getting priced out of a market, a good strategy to go and buy a house for $1.5 to $2 million in Melbourne. And over the next 16 years, I'm sure that property is going to do super well for you. But then if you then decide in 16 years' time, I want to be in Queensland for whatever reason, literally I'm not sure what reason that would be. Anyway, if you did, you then got to sell that property and pay capital gains tax and all the transactional costs that go along with that. That's not ideal. So I'm not sure there's not much you can do about that now, other than, form a strong view on where you'd like to be. But that's the only sort of challenge, I guess, with this strategy is, that's the risk, is we're going to buy into a market and then we're going to have to sell out of that market in 16 years. It's not terrible, but it's just not ideal. Whereas if we're going to build this into a strategy for a client, we typically want to have a lot of confidence that, this is where we want to be. So if I know, if Dave was my client, I know Dave wanted to be in Brisbane, we would really think carefully about where in Brisbane would you like to be, knowing that things could change, goals could change, preferences could change, of course. But hopefully what we're trying to do is buy an asset today, get in, buy the land, don't care about dwelling, buy the land at today's dollars, get our foothold into that market with the strong probability of not needing to sell that down the track. And so even if there's unrealized capital gains trapped inside that asset, we hope that we'll never need to sell the asset. And so at least while we're alive, we'll never need to pay those capital gains. That's an estate issue rather than a personal issue. But, really good question there, Dave. Deserves a bit of attention. And you're right, trying to compare the property strategy to the share strategy. You need to have, it's a little bit like the analogy I keep using is if you go into a Ford dealership, of course, they're going to tell you, buy a Ford, not a Holden. I know that this analogy is a bit outdated. I probably should be using Toyota and Tesla. But, you want to go into a car dealership, which is the best car for me, and get that independent advice, that from someone that knows equal amounts of both those types of cars, for instance, and they're their best then to decide which is the best approach. But if someone only knows, a lot about shares and not very much about property, you're never going to necessarily get that balanced advice. Okay, I've gone over time as usual, so apologies for that. And I've got an interesting episode tomorrow about building wealth with employee share stock plans. So something we come across a lot more often, a little bit complex, and just sort of walk you through that. Anyway, until tomorrow, bye for now. Just a few things before we wrap up, if I may. Of course, you can send me questions at questions@investopoly.com.au. But for a quicker response, feel free to add a comment on the episode's video over on YouTube. We have an Investopoly YouTube channel, and the link is in the show notes. I'm incredibly grateful for the 4.9 star rating on Apple with over 400 reviews. Thank you so much. If you can leave a review or rating, I'd love it, because I'd love to get over 1,000 reviews. That's kind of my target. Keep checking the show notes for free downloads, and I include book discounts there as well. And of course, if you're interested in working with my team and I've included a web link where you can find out a little bit more about what we do and get in touch with us. And of course, until next time, bye for now.